What's going on, everyone? Welcome back to Cash Flows. My name is Wallace, and today we're going to be discussing the 8 must-know things before jumping into the stock market. So I came up with 8 must-know items that I feel like will be very helpful before you start investing into the stock market. So with that being said, let's get into the video. Now, number 1, every investment has its ups and downs. You'll never have a legitimate investment that just increases and increases day after day after day. Now, this is something very natural, very healthy, and very necessary for the economy to function. Now, this is very hard for new or beginner investors to do because they fear the downside more than they praise the upside. So this is something that you just have to become accustomed to and understand that you're gonna have these ups and downs when you're investing. You just have to go into it with the mindset that you're gonna have positive days and that you're gonna have negative days. There's gonna be days where you have less than what you've seen it at its peak, and it is very possible for you to lose your original principal. What I like to tell my clients, let's say they gave me $10,000 to start off with. Tomorrow it's either gonna be $10,001 or it's gonna be $9,999. So you just have to become accustomed to knowing that your money is gonna fluctuate up and down, and that is very natural and very healthy for this to happen. Now, number 2, what I've learned over my time in investing is that you have to be happy with your gains and be happy with your losses, because it could always be much better and it could always be much worse. Now, there will be times where you felt like you've left some money on the table, where you've sold your investment too early, or you may feel like you sold your investment at a loss point. One thing that I would advise you is that it's very hard to buy into the market at the best time, and it's very hard to sell out of the market at the very best time. My advice for that, just be happy with your gains, be happy with your losses, because it could always be much better and it could always be much worse. Move on to the next investment, because if you lose sleep or you focus on how much money you could have made in your past investment, that kind of ruins the opportunity and your focus to find the next best investment opportunity going forward. Now, number 3, it's very important to do your own research. Seek to find your own information on your own investments. Now, me being in the industry for the past 10 years, I've heard all different types of new stocks, new opportunities, new investment opportunities from all different type of people, whether it's my clients, whether it's from my own colleagues, or whether it's just from networking through other investment consultants and advisors. It's really good to bounce ideas off of one another, but what I do, I take that information that I get from outside and I bring it home and I make it fit my own investment style or my investment objectives. Bring that information home and see why that investment makes sense for you, because it makes no sense to take investment advice that someone is using for themselves and apply it to your own investment and your own lifestyle and what you're looking to achieve and your own goals. And if you're brand new to investing, and if you feel like you need some help and you go seek out an advisor and they recommend a specific stock or a specific mutual fund for you, make them explain to you why they feel like this investment is a good fit for yourself. Not why it performs well or why they think it's a good performing fund. Make them give you an answer why it's a good fit for you specifically and what you're trying to achieve. Now, number 4, of course, I think it's a very obvious one. Think long term. Now, of course, real investing is not a get rich quick scheme. And honestly, if you treat it like that, it'll probably be the quickest way for you to lose value in your account. So avoid treating it like it's gonna make you rich overnight. Now, when you first start investing, it may take time for you to see some big or attractive profits. Now, I remember when I first started investing, I was making profits, but they were small profits. And a lot of that had to do with the fact that I was in school and that I wasn't really making the large contributions into my investment accounts. So probably the best thing that I was getting out of it at the time was probably just the experience and the knowledge of investing when I was that young. And it definitely helped me make much more informed decisions down the road later on in my investment career. Those early years when I first started investing, they really did help me down the road to make much more money down the road. So don't look at it as just like, okay, I need to make money now. You need to learn so that you can make money down the road. Now, I feel like overall investing should be a lifetime activity, whether it's stocks in the stock market, or if you're investing into houses, or if you're investing into businesses and you're starting up your own businesses. It actually pays off in a lot of different ways rather than just money. Now, number 5 is another very important one. You have to diversify your investment portfolio. You don't want to have your money focused onto one company or one industry or into one country. There's to invest into different companies and into different sectors and into different countries helps lower your risk, because your money is not focused and not determined onto one or a small amount of factors. It is ideal to have your money spread out through different sectors of the economy, so it lowers your risk and increases your exposure, and it can help increase your profits. Now, number 6, try your best to ignore your own biases. Now, what I mean by that, do not invest into companies just because you like that brand or you like their product. It could be a very poorly run company. Now, on the flip side of that, don't ignore companies that you don't necessarily buy products from, because those could be very well run companies that you could profit off of as well. Now, one thing that you may want to also try to avoid doing is convincing yourself to buy into an investment that you're not 100% sold on. If you're not sold on the numbers or the performance or the actual data or the information of why you're investing into it, then I personally wouldn't invest into it. Now, number 7 is a pretty interesting one. Try to treat the money like it's not yours. So us as humans, we're emotionally attached to our money. We know how hard it was for us to get the money in the first place from our jobs or from our work. We know what we intend to do with the money. Sometimes that money is used for our family members, whether it be for a child's education or to put your family into a home. There's various different examples of how we tie our money back to our loved ones. So that can create an emotional attachment where we hate to see our money decrease in value at any single point. Sometimes we won't even buy something that we truly want because we want to hold on to the whole value of the money and don't ever want to see it go lower than that. Removing that emotional attachment does help with making better, decisive decisions and ultimately does make you a better investor. Now, number 8, probably the biggest part about the stock market is that it's a market. Now, when I hear market, I think of a centralized place back in the day where people back in the day used to get together and they would trade their assets or their goods or their services or their gold coins for other people's goods and services. I think of the stock market or the housing market where you are a buyer or a seller and you're buying or selling a home to another individual. One big thing that you need to understand is that when you're investing into a stock market, you're not necessarily buying a particular stock or a particular asset from the institution that you're using on the platform. You're buying it from another individual that's just like you, trying to sell it on the flip side. Not from a company, not from an institution, but from people just like yourself. So the reason why this is so important is because although we're not necessarily making the executive decisions for these companies, we are controlling the stock price. So collectively, we're ultimately determining the value of these companies on a whole. So I hope you got some value out of this video. Those are my 8 points that I feel like are very important to understand and grasp the concept of before you start investing with your money. Please definitely do like my video and share it with whoever you feel like you can get some value out of it. If you ever have any questions, please feel free to reach out to me, and please do tune into my other videos that will be coming out in the near future. Thank you.